Hello, and welcome back to XRP Insider Network. I hope you're having a great day. If you haven't already, make sure you're subscribed and following the channel. This is where you get real crypto intelligence before it hits the mainstream. No hype, no noise, just signal. Today, we're talking about a structural risk forming beneath the surface of crypto that almost nobody is discussing. It has nothing to do with quantum computing, nothing to do with hacks, nothing to do with market cycles. It's a flaw embedded directly into the incentive structures of most blockchains. And once you see it, you can't unsee it. In this video, we're going to break down why this silent risk could destabilize large portions of the crypto ecosystem over the next decade. More importantly, we'll explain why the XRP ledger was architected in a way that makes it largely immune to this problem. And finally, we'll address why SWIFT building blockchain infrastructure is not a threat to XRP, but a validation of its design philosophy. Let's step back and frame the macro environment we're operating in. We are entering an era defined by capital scarcity, higher real interest rates, energy constraints, and increasing regulatory pressure. This is not the free money, infinite liquidity world that gave birth to most crypto incentive models. The macro regime has shifted. For over a decade, crypto grew in an environment where capital was cheap, yield could be manufactured, inflation could be hidden, and inefficiencies could survive far longer than they ever should have. That era is over. When liquidity tightens, only structurally efficient systems survive. Everything else begins to fracture at the seams, and this is where the real threat emerges. Most blockchains today rely on paid security, proof of work, proof of stake, delegated proof of stake. Different mechanics, same idea. You pay participants to secure the network. You incentivize validators or miners with block rewards. You inflate the native token to maintain decentralization. For years, this was marketed as a feature. In reality, it was always a hidden liability because once you pay for security, security becomes a cost, and costs must always be justified by returns. When returns fall, participation leaves. When participation leaves, decentralization erodes. And when decentralization erodes, the entire value proposition collapses. Let's make this concrete. Proof of work systems rely on energy and hardware. Miners participate because they're compensated. When mining becomes unprofitable, machines shut off. We've seen this dynamic repeatedly. Proof of stake systems rely on yield. Validators lock capital and earn rewards, paid through inflation or fees. When inflation drops or prices fall, that yield becomes unattractive. Here's the key insight most people miss. The security of these networks is not intrinsic, it is rented. As long as you can afford to pay for it, you're fine. The moment you can't, you're exposed. Now contrast that with the XRP ledger. From day one, the XRP ledger was built on a radically different assumption. No incentive is the best incentive. Validators are not paid. There is no block reward. There is no staking yield. There is no inflation-based security model. For years, this design choice was ridiculed. The argument was simple. Why would anyone validate transactions if they aren't being paid? The answer turned out to be far more profound than the industry realized. Validators participate because they need the network to function, because their businesses depend on it, because the ledger itself is the utility. This creates a completely different security dynamic. On the XRP ledger, validators are aligned by usage, not yield. They are there because the network solves real problems. They are there because reliability matters more than rewards. This is a public good model, and when public goods are designed correctly, they are extraordinarily resilient. Now, the threat to the rest of crypto becomes obvious. When validators are motivated purely by profit, they are mercenary. They have no loyalty to the network. Capital moves the moment returns decline. We're seeing this play out in real time. Validator counts are falling, participation is shrinking, costs are rising. Entire ecosystems are discovering that their security model only worked in a bull market. This is not temporary, it's structural. When token prices fall, staking yields collapse. When yields collapse, validators exit. When validators exit, Decentralization weakens, and decentralization isn't a marketing term, it's the core security assumption. Once that assumption cracks, everything else follows. This is why the XRP ledger stands apart. It does not rely on perpetual inflation to fund security. It does not rely on speculative yield. It does not rely on mercenary capital. Its security costs do not scale with price volatility. They scale with usage. That distinction matters. Now let's talk about institutions. We're entering an era where institutional capital demands reliability, not promises, not roadmaps, not incentive gimmicks. Institutions need systems that function in all market conditions: bull markets, bear markets, high rates, low rates. They cannot rely on networks where security disappears when prices fall. This is where many blockchains will quietly fail, not through dramatic hacks or sudden collapse, but through gradual erosion. Validators leave, latency increases, finality weakens, trust fades, capital moves elsewhere. Now zoom in on XRP itself. XRP is not a governance token. It is not a yield token. It is not designed to capture speculative demand. XRP is a liquidity asset. It exists to move value efficiently. Because the ledger does not pay validators, XRP holders are not diluted. There is no hidden inflation tax, no security subsidy coming out of your pocket. That makes XRP fundamentally different and far more compatible with institutional balance sheets. Now, about SWIFT, there's a lot of noise about SWIFT building blockchain infrastructure. Some see competition, others see validation. Here's the reality. SWIFT is not building a public, permissionless blockchain to replace crypto. They are modernizing messaging infrastructure. They are acknowledging the same truth Ripple identified years ago. The future of finance requires real-time settlement, interoperability, and liquidity efficiency. Messaging is not settlement. Data is not liquidity. Infrastructure without a native bridge asset remains fragmented. XRP doesn't compete with SWIFT. It complements what SWIFT cannot do alone. That's why central banks, financial institutions, and payment providers continue to experiment with XRP ledger technology. Now, the regulatory angle. Regulators care about systemic risk, resilience, and predictability. Incentive-heavy blockchains introduce reflexive feedback loops between price, security, and participation. That's a nightmare for systemic finance. A network whose security weakens during stress events is not acceptable. The XRP ledger's incentive-neutral model behaves consistently regardless of price. That makes it far easier to reason about and far more attractive from a regulatory standpoint. Short term, markets will remain volatile. Narratives will rotate. Speculation will dominate headlines. But beneath the noise, infrastructure decisions are being made quietly, and those decisions favor systems that don't break under pressure. Long term, as global liquidity cycles ebb and flow, only networks with sustainable security models survive. Not the loudest, not the flashiest, the most efficient. The XRP ledger wasn't designed for hype. It was designed for durability, and durability always wins. The final takeaway is simple. Crypto isn't just about innovation, it's about architecture, and architecture determines survival. Most of the industry built castles on incentives. The XRP ledger built foundations on utility. That difference is about to matter more than ever. If you found value in today's breakdown, make sure to like the video and subscribe. This is XRP Insider Network, and I'll see you in the next one.